Reserve's two-day policy meeting. Will the central bank raise interest rates for the first time since 2006? Joining the conversation right now is Korn Ferry Vice Chairman Alan Guarino, who has his finger on the pulse in terms of jobs. Alan, good to see you.
Good to see you, Maria.
Thanks so much for joining us. Give us the trends in terms of jobs right now. You're at Korn Ferry. You're placing white-collar jobs. You have a good vantage point of seeing really where are the jobs in this country. So let's start there and then connect the dots to the Fed.
Sure. So, well, first of all, it's interesting. Korn Ferry now, statistically, I think we fill a job every 3.5 minutes around the world. So it's a pretty robust view that we have. Thanks a lot. And we work a lot with companies to actually help them get their folks to do better. So we do both. What we're seeing in jobs is what we would expect. We've had consistency in the recovery around professional services jobs. So those have definitely continued to increase. Healthcare and financial services has finally started to come back a bit. So those are the places where we've seen growth. And of course, all things technology, all things digital. And of course, energy has been challenged. So that's kind of what we've been seeing.
I know the skill set is a big issue. You know, companies can hire, but they can't find the people with the right skill sets to actually put those people in a job. But at this moment in time, do you worry that a Federal Reserve increase in rates on Thursday is going to put a crimp in that job stability that you've been seeing?
Good question. I honestly believe that, well, let's face it, the Fed has to raise rates. We know that. The question is when.
Right.
Is it now? Is it March? It's somewhere probably between now and March. If we do this and it's a moderate rate increase with dovish language, which is what I expect it will be if we raise, then there'll be a reaction probably more in the stock market than in the labor market. So I guess in a nutshell, we have to raise. We're going to raise. Now or 6 months isn't going to change the game. I just think that we're going to have an impact because I think we've been adding lower quality jobs.
How is
That's
it
a good point. I want to get back to that.
Not link, though, a rate hike, you know, I hear it all the time. We have to because we didn't. We made a mistake, so we should go make another mistake. You know, you raise rates. That's deflationary. You have the biggest debt bubble in human history.
Absolutely.
You raise rates. Anyone whose business model, particularly, let's say, if you're an energy company and your business depends on high oil prices and debt, you know, they have to start firing. How is raising rates not a catalyst for something that none of us know the answer to?
Keith, I got to tell you, you're spot on, right? So we talk about zombie companies, right? Okay, zombie companies exist because rates are, quite frankly, artificially low beyond belief. So, yeah, we're going to have job loss when zombie companies go away. But the fact is there's this drive to sort of, obviously, the dual mandate, right? We have to, the Fed has to both manage rates so that they can support a growing economy, but they also have to be mindful of inflation. To be frank with you, I don't see a lot of inflation, although certainly I'm not the economist. So my sense is this having to raise rates thing is driven largely by sentiment, because when you look at the data, I don't know where it's telling us to raise.
Talk to us a little bit about the data. The piece of it that the Fed really looks at is wage rate growth. And it's been really nominal. It's been very, very slow growth in wages over the last several years, and only has really kicked in the last year or so. Are you seeing something different? Tell us the argument on both sides of a Fed increase, where you're seeing wage growth and where we may be underestimating how bad it is.
Sure. So what? 2/3 of the economy is driven by consumers, right? So wages and employment will tell us how strong the economy is going to be and how much it can take in terms of pressure from raising rates. Interestingly, year on year, the average wage growth from 14 to 15 has declined. So as I was on a couple of months back and I said, look, we're adding jobs, but what's the quality of the jobs that we're adding relative to people being able to live and actually spend money in a way that's going to be supportive of the economy? Now, where is wage growth happening? No surprise. The places where we talked about robust professional job growth happening. So life sciences and healthcare, construction, financial markets. But even with those places raising the average hourly rate, across the macro picture, we have had a decline since 2014.
So we're adding jobs, we're adding low-quality jobs.
We're adding jobs that pay, let's say, less than $15 an hour.
This is why the political solution, Maria, is to centrally plan a mandated higher minimum wage. I mean, it's like, oh, they're crappy jobs. Let's just give crappy jobs a higher pay and mandate it. Yeah, isn't that a wonderful American story?
Alan, really important insights. We so appreciate you joining us today.
Maria, thanks.
Thank you so much. Alan Guarino there from Korn Ferry. Up next.